Jai Hind, friends. Every time you hear in the news that the RBI has increased or decreased the repo rate, it may sound like a technical term. Most people ignore it because it feels complicated. But the truth is, this one decision can directly affect your monthly expenses, especially your EMI. So, let's understand this in a very simple way. Banks do not always have enough money of their own. When they need extra money, they borrow it from the Reserve Bank of India, which is the central bank of the country. The interest rate at which RBI gives money to banks is called the repo rate. Now, here is where things become important for you. When the RBI increases the repo rate, it means banks have to pay more interest to borrow money. Because of this, banks also increase the interest rates on loans that they give to customers. And when loan interest rates increase, your EMI also increases. On the other hand, when the RBI reduces the repo rate, banks can borrow money at a cheaper rate. So they reduce the loan interest rates. As a result, your EMI can decrease. Let's take a simple example. Suppose you have taken a home loan. If the interest rate increases by even 1%, your monthly EMI can go up by a significant amount. Over time, this can cost you a lot more money. This is why even small changes in repo rate matter. Another important point is that most loans in India are on a floating interest rate. This means your interest rate is not fixed. It keeps changing based on market conditions and RBI decisions. So, your EMI is not constant. It can go up or down depending on the repo rate. This shows that your personal finances are directly connected to the larger economy. Even if you are not following financial news, these decisions still affect your life. So, what should you do? Before taking any loan, you should understand how interest rates work. Always be prepared for possible increases in EMI. Do not take loans assuming that your EMI will always remain the same. In simple words, the repo rate is a powerful tool. It controls how expensive or cheap loans are in the country, and because of that, it directly affects your monthly budget. If you understand this one concept, you will make better financial decisions and avoid unnecessary surprises because, in the end, it's not just about taking a loan, it's about understanding how that loan behaves over time.